The markets are currently closed for the Thanksgiving holiday, but the last trading session left us with a fascinating, volatile picture that demands our immediate attention. Nuburu Inc., ticker symbol BURU, closed the Wednesday, November 26th session at exactly 0.2204. This represents a significant intraday surge of 7.72%. with the stock oscillating between a low of 0.2049 and a high of 0.2245. What makes this movement particularly arresting isn't just the percentage gain, it's the volume. We saw over 22 million shares change hands, a figure that speaks to a sudden, violent resurgence of interest in a company that many had left for dead. If you are holding BURU or watching from the sidelines, you are staring at a classic battleground where retail optimism is clashing with institutional skepticism, and the closing price of 22 cents is merely the scorecard for a much larger game being played behind the curtain. Here is the expectation that most traders have when they see a stock like Nuburu. They see a distressed penny stock, beaten down by over 50% in the last year, grappling with compliance issues on the NYSE American, and burning cash like a furnace. The general consensus is that this is just another tech dream that failed to materialize, a company with cool laser technology that couldn't find a profitable market fit. That is the expectation, a dying ember. But the reality is substantially more complex and frankly far more aggressive. Nuburu is no longer just a blue laser manufacturing company. Over the last few months, and specifically solidified in this third quarter of 2025, it has executed a hard pivot into becoming a diversified defense technology holding entity. This isn't a simple restructuring, it is a fundamental metamorphosis. They are leveraging their core IP to aggressively acquire and partner with European defense firms like Techne SPA and Orbit SRL, effectively rebranding the investment thesis from industrial manufacturing to electronic warfare and operational resilience. If you are analyzing this stock based on its ability to weld battery packs for electric vehicles alone, you are looking at the wrong map. The reality is that BURU is attempting to backdoor its way into the massive global defense budget using its laser tech as the wedge. Let's analyze the recent market behavior with a microscope. The surge to 0.2204 on Wednesday was not a random fluctuation. It was a continuation of high volatility churning that we have seen throughout November 2025. When a stock trading at 20 cents sees 22 million in volume, it indicates a massive rotation of the shareholder base. We are seeing the capitulation of long-term holders who have been underwater since the reverse split in 2024, handing over their shares to speculative capital that is betting on this new Nuburu defense narrative. The price action shows a distinct support level forming right around the 20-cent mark. Every time the stock dips toward 20 cents, bid support steps in, suggesting that the market views this level as the floor for the company's current valuation. This psychological anchor point is crucial. In the world of high-risk trading, specifically when using interactive brokers or watching the order flow on a thinkorswim terminal, you look for these accumulation zones. The fact that BURU held the line above 20 cents despite broader market pressures leading into the holiday suggests that the smart money, or at least the risk-tolerant money, is positioning for a catalyst. To understand why this pivot is so jarring, we have to look at what Nuburu actually does. Historically, the company was built on a singular, powerful scientific premise: the superiority of blue lasers over infrared lasers for processing non-ferrous metals. Standard industrial lasers, the kind you might see analyzed alongside NVIDIA stock when discussing high-tech manufacturing, typically use infrared light. The problem is that metals like copper and gold, which are absolutely critical for the electrification of the economy, including Tesla stock components and consumer electronics, reflect infrared light. It's like trying to heat a mirror with a flashlight. Most of the energy bounces off. Nuburu's blue laser technology operates at a wavelength that copper absorbs 13 times more efficiently than infrared. This allows for defect-free welding of copper foils in batteries, a holy grail for the EV industry. However, the expectation was that this technological edge would lead to massive, immediate revenue growth. That didn't happen fast enough. The capital expenditure required to scale, combined with a slower-than-anticipated adoption cycle by major auto manufacturers, left Nuburu with great tech but a bleeding balance sheet. This brings us to the Nuburu defense strategy, which is the engine driving the current speculation. The recent execution of a €2 million financial support tranche to Tecme SPA, an Italian company, is the smoking gun of this new direction. This isn't just about selling lasers anymore. It's about integrating their high-power light engines into defense systems. Think anti-drone weaponry, optical countermeasures, and secure communications. By moving into the defense sector, Nuburu is attempting to tap into government contracts, which are sticky, long-term, and often recession-proof. This is a stark contrast to the cyclical volatility of the commercial EV market. Furthermore, the acquisition of Orbit SRL adds a software layer to their hardware offering, specifically in operational resilience. This is a buzzword-heavy term that essentially means ensuring military and critical infrastructure systems can keep working when under attack. The market is trying to price in what a blue laser plus defense software hybrid company looks like. Is it worth 22 cents? Or is it worth multiples of that? That is the question driving the 22 million share volume. We must also discuss the financial mechanics here because they are perilous. The Q3 2025 earnings report was a mixed bag that requires a nuanced reading. On the surface, it looked rough, a gross margin of $0 and a net loss that continues to widen. If you are using a standard screener on Fidelity Investments or Schwab Intelligent Portfolios, BURU would be filtered out instantly. However, the balance sheet showed a spike in cash to $5.9 million, up significantly from the start of the year. This cash didn't come from operations, it came from financing. They are keeping the lights on and funding these acquisitions through debt and equity issuance. This is the double-edged sword of the penny stock world. The company has the capital to execute its new strategy, but that capital came at the cost of dilution and increased leverage. For the individual investor, this is the primary risk factor. The share count has expanded, and if the defense strategy doesn't yield revenue quickly, the only way to fund the next quarter is to print more shares, further diluting your stake. It is a race against time. Let's pause for a moment. I want to hear from you. The defense sector is seeing a massive influx of technology due to global geopolitical instability. Comment below with your thoughts. Do you think Nuburu's blue laser technology will actually be adopted for anti-drone warfare, or is this just a corporate pivot to save a sinking ship? I want to see your analysis in the comments. Now, let's contextualize this for the modern investor. If you are sitting at home, managing your own funds via Robinhood or SoFi Invest, you are constantly bombarded with options. You could take the safe route, buying into broad index funds or blue-chip staples. You could look at Apple stock and be content with steady, slow compounding. But the reason you are looking at BURU is because you are hunting for asymmetry. You are looking for the asset that is mispriced because the market hasn't fully digested the new narrative. This is similar to the appeal of crypto trading on Robinhood Crypto or chasing breakout stars in the biotech sector. You are betting on a re-rating event. For Nuburu, that re-rating event would be the announcement of a definitive material contract with a NATO-aligned defense ministry. The partnership with Tecme is a stepping stone, but the market needs to see a purchase order with a government stamp on it. Until that happens, the stock will likely remain volatile, trading on rumors and press releases rather than fundamental cash flow. The leadership change is another critical piece of this puzzle. The implementation of a co-CEO structure with Alessandro Zamberni and Dario Barassoni is unorthodox. In the United States, co-CEO structures are often viewed with skepticism. They can lead to slow decision-making and power struggles. However, in this context, it signals the Europeanization of Nuburu. Alessandro Zamboni is the architect of the Orbit and Techne deals. His presence at the helm confirms that the company's future is tied to the European defense market. If you are holding BURU, you are essentially betting on Zamboni's Rolodex. You are betting that his connections in the Italian and broader European defense sectors will convert into contracts for Nuburu's US-based laser technology. It is a cross-border arbitrage play. It is also